Welcome back to another Metrics e-learning module. Today, we are going to look closely at one of the most important decisions you will make for your recurring revenue business: how to choose the right subscription management system, or, in everyday terms, your automated invoicing setup. Over the next 10 minutes, we will equip you with the knowledge to make the choice that perfectly fits your needs, allowing your finance team to scale without adding unnecessary complexity. We've divided this module into 4 straightforward chapters. First, we will walk through the 4 main architectural models available on the market. Then, we will dive into the specific considerations and operational challenges you will inevitably face. Finally, we will look at how different system types impact your daily bookkeeping, your data quality, and your budget. Let's jump right in. Let's start by establishing a core principle. Choosing an invoicing system is not just about buying slick software, it's about finding the right balance between your commercial, go-to-market setup and your financial data integrity. To help you evaluate this balance, we will first look at the 4 main benefits a strong subscription management setup should deliver to your business. After that, we will explore how companies typically land in one of 4 distinct architectural models to achieve them. Let's start with those 4 core benefits. So, what can a strong subscription management setup actually do for you? Let's break it down into 4 main benefits. The first is process automation and optimization. Handling subscriptions manually takes a massive amount of time. By automating the entire lifecycle, including upgrades, downgrades, and pro rata calculations, you save countless hours. The second benefit is overview. A great system doesn't just show you upcoming invoices, it gives you an easy, detailed overview of your full contracted MRR for the coming years, as well as the cash flow generated from current contracts in the future. Metrics delivers this detailed information right down to the specific customer level, tracking revenue development and consolidating it into a super clear overview for management. The third benefit is quality in your invoicing. You want to avoid manual errors, missed invoices, and ensure that your revenue deferrals and accruals are booked correctly according to accounting standards. Metrics is unique because it is not a separate subledger. Instead, it is built directly on top of your existing accounting software. It pushes lines directly into your ERP, ensuring that your financial data is completely accurate and audit-ready from the start. The fourth benefit is analytics. You need a clear view of your most vital SaaS metrics like churn, retention, and growth. In a modern setup, analytics shouldn't just look at the data generated inside an isolated billing module. The ideal approach is to leverage a system that pulls and analyzes all the historical data already living inside your accounting software, giving you a complete, unbiased view of your growth journey from day one. Now that we have covered the 4 core benefits you should expect from a great setup, the real question is, how do you actually achieve them? This is where architecture comes into play. Depending on your sales volume, contract complexity, and how you want your data to flow, your business will naturally lean toward one of 4 distinct structural models available on the market today. Let's break down the first and most traditional approach. The first model is the traditional one. You run everything manually or semi-manually directly inside your ERP or accounting system. In this setup, you create, book, and dispatch invoices yourself. This works perfectly fine if you only process a few invoices every month, run sales-led B2B contracts with frequent changes on invoicing, and have a very high-touch relationship with your clients. However, as soon as your volumes increases, contracts become product-led, and invoicing increases, this manual work will quickly become a massive bottleneck. The second model is the hybrid approach, which is where Metrics operates. Here, you get full automation of the entire subscription lifecycle, which saves a lot of time, and the system is built directly into your existing accounting software. And you can run a single source bookkeeping with all your data in your ERP system. The distinct advantage here is that you eliminate manual errors, handle upgrades and downgrades automatically, and get automatic revenue recognition on a line item level, all while your accounting system remains the single source of truth. You essentially scale your business without creating isolated data silos with integration complications. The third model involves large global subscription engines like ChargeBee or Stripe Billing. These systems pull the entire customer journey and subscription management out of your accounting system, acting as their own closed subledger. They are powerful engines, but they also create significant data silos. Realistically, this model is only optimal if you have very high volumes and require handling of smart payment card retries, customer payment communication, and onboarding. This option is relevant for if you have thousands of customers with monthly transactions and rely heavily on a product-led growth model with self-serve credit card checkouts directly on your website. The fourth and final model consists of highly specialized heavy B2B systems like Unium. These are built specifically for enterprises with extremely complex contracts, difficult midterm changes, intricate pricing structures, bulk price indexing across various currencies and legal entities. But keep in mind, just like ChargeBee, these are heavy parallel systems. They require extensive implementation, historical data migration, and ongoing maintenance of expensive API integrations. Before choosing how to automate your billing, you need to be aware of some fundamental traps that many scaling companies overlook. Let's look at how these technical challenges impact your daily business and how the architecture behind metrics is designed specifically to avoid them. The first major trap is the integration and ID silo trap. External subscription platforms operate as independent systems with their own internal customer and product IDs, completely separate from your accounting ledger. Forcing these two worlds to talk together requires custom API mapping, which complicates your data flow and frequently leads to sync mistakes. Maintaining these complex setups is incredibly expensive. It drains your internal team's time and requires costly external IT resources just to keep the integration from breaking as your business grows. Metrics completely sidesteps this by using your existing ERP data structure, saving you from heavy integration debt and costly manual errors. The second trap is the changes back in time mutation. External subscription engines view time as fluid, allowing retroactive recalculations if a customer changes their plan mid-month, but your accounting system views time as strictly immutable. Once a period is closed, it cannot be changed. Trying to sync these conflicting views via an API creates constant errors, forcing your finance team into a monthly nightmare of manual reconciliations. The third trap is local VAT and compliance. European ERP systems are built from the ground up to handle specific local VAT rules, one-stop shop regulations, and reverse charge mechanisms. Global subscription engines often rely on external tax calculators that might classify VAT in ways that conflict with local requirements, complicating your sequential invoice numbering and leaving you vulnerable during audits. So when should you actually migrate from one model to another? The rule of thumb is quite simple. You should only graduate to a more complex external system when the manual hours and operational costs of your current setup exceed the engineering cost of building and maintaining an external API integration. If you are a strictly European B2B company, it is almost always safer and more compliant to keep your bookkeeping centered in your native ERP system. Let's look at what your choice actually means for your daily operations. The biggest architectural difference between Metrics and other models like ChargeBee, Unium, or Finerum is where your data lives. Metrics is built on the principle of single-source bookkeeping. This means that 100% of your data, customer history, and documentation stays right inside your existing economic system. Why does this matter? First, you completely avoid vendor lock-in. Because all your data lives in your own accounting system, you own your history entirely and are never held hostage by an external platform. Second, it makes your bookkeeping perfectly audit-ready. Your auditor only needs to look in one place because the numbers in your system will always match the cash in your bank account. This saves significant time and reduces expensive external advisory fees. When we look at functionality and economics, the pricing models are also worth noting. Heavy external systems often charge premium rates that scale aggressively with your invoice volume or revenue. Hybrid systems like Metrics would typically be half the price of these solutions, while also enabling you to save significant internal and external resources on complex integration and initial setup. Furthermore, because Metrics reads directly from your accounting ledger, it provides deep analytics on all your historical data from day one, something external platforms simply cannot match. To make this decision highly practical for you and your team, we have put together a final checklist. You should ask yourselves 3 simple questions before choosing your next system. Question number 1. Is your sales model high volume and credit card driven, or is it primarily sales-led B2B? External engines are built for high volume plays, whereas hybrid models are typically better suited for B2B companies. Question number 2. Do your customers have a high level of self-service for mid-term changes, or do your customer support or sales teams handle them? The complexity of an external engine is designed specifically to support high self-service levels. And question number 3. Are you willing to accept the friction and complexity of external data silos, or do you want to keep your ERP as your primary source of truth for bookkeeping? If you want to keep your ERP as your main financial system, you should consider a hybrid model. That brings us to the end of this module. Remember, the right tool should save you time, reduce errors, and create total transparency across your sales, finance, and management teams without tripping up your bookkeeping compliance. Thank you so much for following along, and best of luck future-proofing your invoicing and subscription management.